Hello, good evening, everyone.
Good evening.
Hi, welcome to the webinar brought to you by Arvin Huang Investment Bank. So before we start, let's have a quick check on sound. So if you can hear us loud and clear, please type yes on the comment.
If you can hear us, please type yes on the comment. Hi. Hi, Sam. Hi, Ailey. Hi, Chi Sing. Thank you so much. That's the first yes. Second yes. Thank you, Sam. Thank you, Mr. Chuck. Right.
So while we are doing the sound check, also appreciate your help to share or invite your friends to join this webinar. Okay, thank you for those who provide the feedback for us. So looks like all good, all set and good to go now. So good evening, everyone. Once again, I'm Sukiang, and beside me is Jason. We are from Equities Tracker. So tonight we are going to talk about boosting your investment returns with warrants. And this education webinar is brought to you by Arvin Huang Investment Bank. So thanks again to Arvin Huang. So before we start, disclaimer, whatever is being shared and discussed tonight is purely for education purpose only, not intended for any investment advice. So should you look for any investment advice, please contact the licensed investment advisor. Thank you. For tonight's session, we will separate into three parts. What is warrant? Key indicator to evaluate warrants and managing risk when you investing in warrants. So what is warrant? So warrant actually are derivative that give you the right but not the obligation to buy or sell a security. Normally, most commonly an equities at a fixed price called exercise price or strike price before expiration. So some investors like the warrants very much because of its leverage effect. So what is leverage effect? Actually, the movement in the warrant price are usually much more greater than the movement in the underlying share price. So which means their potential to deliver a higher percentage return is also increased. So let me put it into a more simpler way for you to understand. Imagine that the stock is a cake, and this is a very special cake, very delicious, yummy, everyone loves it. And this cake costs you 10 ringgit. It is prepared by the cake seller, and the seller is very keen and dedicated in operating the bakery. So after a while, the seller also make a very good relationship with their customers. So in order to boost the bakery business, the cake seller decided to issue a voucher to his customer. So if you bought a 10 ringgit cake, you will receive a 5 ringgit voucher. Of course, with the terms and condition. So the terms and condition is that using the voucher within the fixed period of time, if you plan to buy a cake, you are welcome to go back to the shop again, utilize the voucher plus paying 5 ringgit in cash, additional 5 ringgit. So then you will receive a new cake, same like what you bought before. And most important terms and condition is that you must have already bought the cake before, which means to say you must be a regular or existing customer of this bakery in order for you to entitle to receive the free voucher. So as I mentioned before, this is a very special, delicious cake. After a while, you miss the cake again and wish to eat the cake again. And so this time you decided to visit the bakery again. make use of the 5 ringgit voucher on hand and top up another 5 ringgit in cash to convert and receive a new cake. Remember, you are the customer and who bought the cake before, so you are entitled for the conversion. So utilize the voucher plus top up 5 ringgit in cash, you will enjoy a new cake. So take note that the cost of having this new cake is only 5 ringgit to enjoy a new cake which selling at 10 ringgit. So compared to a totally new customer who didn't buy the cake before, you have some advantage and consider this is a good deal for you. So among the loyalty customer who received the voucher, not all of them convert or utilize the voucher immediately. So you have the right of freedom to use it within the time frame given. Okay, so remember there is an expiry date, but you can use it within the time frame given. So as the time passes by after 1 year, 2 years, or after 3 years, so do you think that this cake will remain selling at 10 ringgit? As I mentioned before, this is a very delicious and hot selling cake. Normally the cake will appreciate along the time. So it will appreciate over the time together with economic growth. Remember, right now, right, we are living in a high inflation rate now. And in addition, it will appreciate with different kind of valuation. So because after 2 or 3 years, the reputation of this bakery has been built out and spread around. So we need to factor all these additional factors. So all these additional factors enable the cake to appreciate from 10 ringgit, say 10 ringgit to 20 ringgit. Let's look at the voucher. It is still a valid voucher with unchanged terms and conditions. As a qualified customer, you are still entitled to top up 5 ringgit in cash and receive a new cake. But at this point of time, the cake that we receive now is no longer 10 ringgit cake. It has appreciated to 20 ringgit. So different timing, it has a different value. So in this case, it's appreciation. So 5 ringgit voucher you received some time ago. In this case, what do you think? How much is the real value of the voucher right now? Anyone have any idea for this case? So obviously it's no longer 5 ringgit, right? It must be more than 5. So it is much more valuable than 5 ringgit. So actually, you will notice that as time goes by, the cake has been appreciated from 10 ringgit to 20 ringgit. And at the same time, the face value of voucher also appreciated. So it appreciated, obviously, from 5 ringgit to 15 ringgit. Yes. So notice that the growth rate of cake and the voucher are different. Okay, for cake, it appreciated and increased 100%. Whereas the voucher has appreciated 200%. So, which means it is much more higher than the cake, the growth of the cake. So, if we were to relate the cake and voucher to our topic tonight, the cake actually refers to the mother share, whereas the voucher refers to the warrant. So, we will discuss further later on about this. So, and I hope through this simple sharing and analogy, you can understand it easily, especially for those beginner. So just now we mentioned before, for the warrant, you can convert it to the mother share anytime by paying the fixed exercise or strike price. So just to give you some idea, the cost of having a newly issued mother share equals to the warrant price plus the exercise price. So, but question over here, whether worth to convert it, we have to check the current market price of the mother share, and which we will discuss in later, more in detail in next part. So when we talk about warrants, so some might raise the concern. There are actually 2 types of warrants in the market: company issued warrants and structured warrant. So what are differences between these two and how to differentiate? As an investor, we must know the differences, and when we decided to make some decision to invest it. So first we look at the structured warrant, which can be further divided into the call and put warrants. So structured warrants are actually issued by the third party. So when we say third party, is actually not by the listed company itself. It could be issued by the investment banks or other financial institutions. So bear in mind that it can only settle by cash and cannot convert into the ordinary company share. So the conversion ratio and also the exercise price has been fixed when it is issued. So basically, we can treat this structured warrant is a kind of a tradable financial product with maturity period. So let's look further for call warrant and put warrant. So what is call warrant? It's actually a right to buy underlying asset at future date at fixed price. So if you have a bullish view, so how to apply it? If you have a bullish view on the underlying asset, then you may consider call warrants. So call warrants is actually normally tradable during or in bullish market. Okay. So after you bought the call warrants and underlying, it happens that underlying share price rises sometime later after you bought the call warrant, you will be profitable. So call warrant has the code, take note that has the code with C. Okay, example, Maybank C81, C82. For put warrant is actually the other way around. Put warrant is the right to sell underlying asset at future date at fixed price. So if the underlying share price at peak right now, the price at peak, and you have a bearish view on it, which means you think that this mother share or underlying share has the tendency to move down, is very high, then you may consider put warrants. So put warrant normally is tradable during the bearish market, and it has a stock code started with H. So example, CIMB HF. So put warrant is a bit special. We buy high and sell low, yet we still can make a profit. Okay, normally we buy low and sell high, but this is the other way around. Buy high, sell low, still can profitable. So, and one more important thing is that both call warrant and put warrants has shorter trading period of time. So normally range between 6 to 12 months. So remember that it's not meant for buy and hold. You have to consider it to sell at the right time. So you may already notice that both company warrants and call warrants, both they have one commonality. What is that? Just now we mentioned, we always aim for buy low and sell high, right? Yes, both of them having this same commonality. You will be profitable when underlying share price rises after buying company warrant or call warrant. But yet you still need to know the differences between these two. So let's have a look what are the differences between company warrant and also the structured warrant. So company warrant normally issued by the listed company itself, whereas call warrant is issued by the third party. Just now I mentioned that the third party could be investment bank or any other financial institution. And secondly, call warrant is American warrant. So what is American warrant? When we talk about American, what is the sign of? Normally, they always look for the liberty or freedom. So American warrant can convert to mother share since listed day one, not necessary to wait until maturity date. So for call warrant is normally European type in our market in KLSE. So which means it can be only convertible into cash upon maturity. So can only convert during maturity date and convert into the cash. And one more difference is the maturity period. Company warrant normally expired in 5 years and some until 10 years, whereas call warrants will expire normally in 6 to 12 months. So notice that is a very much more very big difference in terms of the timing within a year and compared to 5 or 10 years. Okay, so I hope this will give you some picture how to differentiate company issue warrant and the structure warrant. Okay, so next I pass the time to Jason to continue with the second part.
Okay, thank you, Swee Kiang, for the very simple and easy illustration of what warrant is. Next, we'll walk you through how to evaluate warrants, what are the indicators, and how to allocate them and manage the risk of warrants. So, how might we know if a warrant is good or bad for investors like you and me? Now, firstly, we are going to put some context to the indicator, and today we are going to talk about Frontcan Corporation Berhad, Malaysia's leading precision cleaning specialist. Now, have any of you heard or owned this company before? If you have, just type 128. Their stock code is 0128. I'm not asking you to buy or sell, this disclaimer, but just for today, we are going to learn about Frontcan and how is their warrant is interesting or not. Okay, let's have a show of hands. How many know this company or own this company? If you have, just put a 128 to the conversation. No, thank you, Thomas. So that's one. Oh, Lim Hian.
Mr. Lim. Any more? 0128 or 128?
128, just 128. Himin. Pang Himin.
Yes. Thank you.
Thank you so much. Chi Seng, thank you. Now, all right, first off, who is Frontcan and what do they do? And most importantly, why Frontcan? Now, as mentioned just now, right, Frontcan claims to be Asia Pacific's leading surface engineering specialist. They specializes in two key business. Number one, precision cleaning, and secondly, on surface treatment solution services. Surface treatment, especially. Now, this precision cleaning, right, is at very microscopic level. We're talking about less than 3 microns. A piece of paper is 70 microns. A piece of paper, A4 paper, is 70 microns. 70. Our typical hair, right, has a thickness between 50 to 120 microns. And here we are talking about cleaning particles less than 3 microns. Now, Frontcan predominantly serves the extreme condition industry. Now, such as semiconductor industry, particularly on the front-end wafer fab foundries. Now, other than precision cleaning, they also services automotive electronics, oil and gas, petrochemical, and power generation sectors with their proprietary surface treatment technology for more than 150 customers in Taiwan, Singapore, and Malaysia. Frontcan works with international wafer fab companies such as TSMC and equipment manufacturers to develop best precision cleaning and surface treatment solution for 200 millimeter or 300 millimeter silicon wafers. So these wafers are in the shape of 200 millimeter or 300 millimeters round shape. Now, this semiconductor industry, right, has been experiencing very strong growth for the past 60 years. There are more than 100 new wafer fab facilities across the world in the next 5 years. All new ones, okay? All new ones. So all these are opportunities for cleaning companies, for OSAT, for the whole semiconductor industry. In fact, world's largest independent wafer fab foundries, TSMC, plans to spend $100 million to expand their 3 nanometer and 2 nanometer microchip production line for the next 3 years. And all these are great opportunities for OSAT, AT, and cleaning companies like Frontcan. Microchips has come a long way from as big as a piece of A3 paper to merely a few nanometer nowadays. However, when the microchips goes beyond 7 nanometer and below, 7 nanometer and below, 7 nanometer and below, precision cleaning become extremely critical, as we really can't afford to waste 3 months effort to produce the wafer, design, draw, and coat the wafer just to have hundreds of chips goes to waste. And this is Frontcan's forte. Frontcan usually starts involved with customer during the R&D stage. So from very beginning, when you have the ideal generation, when you have the R&D stage, right, Frontcan is already there. And from design, testing to massive production rollout, right, Frontcan is working with client to design how best to precisely clean up to 1.4 nanometer microchips. So they're no longer considering about 3 nanometer. That one already is history. Okay, with the commercial rollout of 3 nanometer microchips in second half of 2022, will Frontcan be able to capture this opportunity? That's a question mark, right? Next slide, please. Now, if we were to look at Frontcan for the past 10 years, they have been making positive net profits 9 out of 10 years. And their operating cash flows and free cash flows have been fairly healthy. Although it's only 5 out of 10 years paying dividends, right? But those are in the past. Last few years, right, they have been paying gorgeous dividends since the semiconductor boom these few years, and thus giving them a FQA scoring of 85%. Then if we were to focus on the recent financial year, FY 2020, 85% of their revenue comes from semiconductor industry in Taiwan, Singapore, and Malaysia, 85%. About 15% comes from servicing rotary equipment from petrochemical and oil and gas industry. For the past 10 years, their sales has been growing at a pace of 9% CAGR yearly. And for the first 9 months 2021, they have recorded 328 million ringgit. Almost a full 2020, that's 12 months of financial year revenue, thanks to their exposure in the booming semiconductor industry.
So this will, which means that for 2021 definitely will be a record high as compared to
not yet record high. We cannot say for sure. I haven't seen the 4Q quarter result, so we have to wait until February to actually know about that. Now, as for their profit after tax, I believe the numbers speak for themselves, with a whopping 46% CAGR yearly, making a loss in 2013 to scoring 88 million in 2020. In fact, for the first 9 months of 2021, they achieved a record-breaking 97 million profit, thanks to the growing net profit margin and robust microchip demands due to trade war and the shift in business and logistic landscape. Now the question is, will fourth quarter turns out to be a yet another record-breaking quarter?
Let's see.
I have no idea. Disclaimer. All right.
Okay.
But let's come back to what we wanted to talk about tonight. How to evaluate the pros and cons of warrants. Now, these are the 6 key indicators from KYC Screener. We can easily get exercise price, exercise ratio, maturity date, and issuer from the Bursa Malaysia website anytime, 24 hours. However, for your day-to-day trading, right, it's essential to take in the value of share premium percentage and gearing ratios as well. Now, for us, there are 3 key things that we always, and I say always, keep in mind, which is the share premium percentage, which tells us if the warrants is in the money or out of the money, which is if we were buying the warrants at discount or paying premium. Sorry, the other way around, by percentage. And secondly, is the gearing ratio. A simple rule of thumb is the bigger the gearing ratio, the bigger the leveraging effect, which gives us bigger exposure to double and triple our reward. And risk, yes, the risk as well.
The other way around as well.
It's both ways, double-edged sword. So
Okay.
definitely we kena one. Definitely we kena one. And lastly, we must always take into consideration the maturity date. Just like your average cakes and groceries, less people want them when it's near to maturity date. Thus naturally dampens the warrant price. And obviously, we are going to look at the 52-week low and high to gauge roughly where we had been for the past 12 months. And the last check would be that this warrant is really issued by the underlying share and not underwritten by some third-party institution. After all, we are buying into the future of the underlying shares and not just a share certificate when we invest, right? So what do we need to know about share premium percentage? As what we mentioned earlier, warrants has maturity dates. Now, typical company issued warrants list and open for trading for about 5 to 10 years. Now, during this 5 years trading period, the warrant price tracks the movement of the underlying mother shares and goes between premium and discount zones. It's common to assume that when the warrants drops into the discount zone, it's considered as cheap. Now, and vice versa when it goes back to premium zone. However, most of the time, the warrants stays in the premium zones. And as warrant gets closer to maturity date, right, they become unloved and typically less trading, just like the cakes and groceries have moved towards the discount region. So when you see that they are in the discount zone, do keep an eye for the maturity date, or you might end up in a value trap. Now about gearing ratio, some would say the bigger, the better. It is somewhat true. If you are looking to spend the least amount of capital, the biggest potential returns possible, then probably you might want to look at structured warrant as they use the steepest effective gearing effect. Now imagine the underlying share A, it's at 5 ringgit today, and the warrant is at 50 cents. 5 ringgit, 50 cents, which yields about 10 times gearing. 5 ringgit over 50 cents, 10 times gearing. Now, when the company goes up 1 ringgit from 5 to 6, which is the 6 ringgit, or a 20% increase, at a fixed exercise ratio of 1:1, the warrant price will have to follow the increment and increases to 1.5 ringgit, 1 ringgit 50 cents, also increase 50 cents, or a 200% absolute return to upkeep the share premium percentage. So, however, when the share price takes a dive, it also brings the warrants to a dip. And that's when the warrants goes into share discount regions. It is cheap at this moment. But are you planning to buy a company just because it's cheap? Now, let's take a look at the real case study we did back in 2017. We were very interested in Kellington Group Berhad, a ultra high purity UHP gas delivery solution specialist to semicon and electronics industry. Now, both mother share and warrant was at roughly 35 and 6 cents, which yields a gearing ratio of about 5.9 times, somewhat similar to Frontcan and its warrant B today at 7 times. Now, after a 2 years period, we decided that it might not be able to weather the 4G to 5G transition period. And so we decided to take some profit at 74 cents. The warrant price actually went up to 84 cents after that, before they dampened due to nearing maturity date. Now, through these 2 years, although Kellington did distributed some dividends, and we noticed that it did yield almost 400% of absolute return to our portfolio, including dividends, almost 400%. Now, however, the biggest winner is the warrant, which gives us a whooping 11 times return of the money we put in. Warrants with a good gearing ratio is your friend. If and only if the underlying share is growing and becoming better and better. Now, however, when the company doesn't perform, warrants might just turn around and to be your biggest financial crisis.
So in this case, is your biggest enemy.
Who knows? Who knows? So in part 3 of today's session, we'll be talking about how to manage the risk of investing in a warrant. So I believe we all agree that warrant is a double-edged sword. Yeah?
Yeah.
Definitely, right?
Can be your friend
or your foe. So definitely warrants can warrant a significant returns if they perform. But bear in mind that warrant can also koyak your portfolio if you allocate too much percentage in your portfolio. So the question back to you is, to warrant or not to warrant? Always, and I stress once again, always remember that warrants or structured warrants has maturity period. Please don't wait till the last minute to trade or to convert them into underlying shares, or it might turn out to be a bunch of waste papers in the end. On top of that, warrants is a leveraged investment product with maturity period, so always look out for the gearing ratio and maturity when you decide to pick up some. And please note that there is a profit dilution effect when they list the warrants up in KLSE, as these warrants eventually converts to the underlying shares in the future, thus increasing the overall number of shareholdings listed. And so this gives a perspective, right, that the mother share or underlying share fundamental changes. Lastly, do observe the share premium trend. They normally don't sway away from the 5% to 50% share premium trend, unless nearing to maturity date. And by observing the share premium percentage trend might just become your most trustworthy trading indicator. It is quite a common practice that when company ask shareholders for fundraising through rights issue and throwing in free warrants as good faith. Take it as like when you buy 2 cakes and get a discount voucher to buy cake in the future. Yes, you get to buy a whole new cake using less money in the future. But that also means more business for the cake seller, more money. And this is what we meant by warrants is sometimes a sugarcoating strategy.
Or some say sweetener.
Sweetener, that's a more common word. Yes, definitely. Thank you, Sweetie, on that. Now, despite the risk and the reward, the question still remains. To warrant or not to warrant? That, I leave it to you. Thank you once again. I hope you learned a thing or two tonight. Do let us know if you have any questions. We'll try our best to come back to you. Over to you, Sikang.
Yes, so thank you, Jason. So if you have any question, do drop your question on the comment or chat board. So we'll have a look on it after that. So before we go into the Q&A, allow me to share some info with you. So in conjunction with tonight's topic, we would like to announce an outgoing structured warrant campaign organized by Bursa Malaysia from 1st November 2021 to the 28th February 2022. Diversify and expand your portfolio today and be rewarded with 100 ringgit GrabFood voucher by participating in this campaign. Of course, with the terms and conditions apply. So for more information, please visit to www.bursamarketplace.com/rewards. So to the attendees today who are not yet clients of Arfin Huang Investment Bank, you are always welcome to open a trading account from the website einvest.arfinhuang.com/sign up and start your structured warrant trading from now until 31st of January 2022 to win the rewards. So if you will open an account and complete two trades with Afin Huang Investment Bank, you will also entitled for the open trade and win campaign. Okay. For more information, again, refer to www.bersammarketplace.com. And with any other investment, investors should make sure that they are fully understand the characteristic of warrants before deciding to invest in any of one of them. So remember, just now we talked about some kinds of warrant. So at least you must able to differentiate what is structured warrant and what is company warrant. But of course, if you would like to get the slides tonight, do refer to this link. Later, our colleague will help to post the link inside the chatbot. And just now we mentioned, for those not yet an customer or client of Afin Huang, do refer and register your interest here. Refer to the link, this link. Okay, so we can start to have a look on the question asked by our participant tonight.
All right, thank you, Sukyang. Right, so we do receive a few questions here. Now, Rasmawi Y from YouTube asks, what happens to our money after the warrant expiry date? That's a very good question. We actually had that experience before, so
it's a very painful experience.
Very painful experience.
Yes.
So just like the discount vouchers, right? If you go to KFC or go to Aeon voucher or anything, right? If after the expiration date, what happens to the discount voucher? You cannot convert it to cakes. You cannot convert it into mother shares. So it's exactly the same. It becomes a waste paper. There's nothing there, no value. So your money all just go away already. If you actually bought the warrants lah. But if it comes for free, right? Then
it's
not
still
much loss. Not much loss.
Still,
it's just
okay.
a extra waste paper there.
Also, in certain cases, then when it comes to majority, there's no point for you to convert, because after you convert it, it's much more expensive or higher cost than you rather than buying a mother share from the market. So say for example, after you convert, it's already cost you 70 cents, whereas in the market share is only 50 cents. So which one do you choose?
Exactly. So no point, right? But then there was not a buy or sell or convert advice.
Yeah, again, this is for example. But of course, during any time from day one until majority, so if you found that by conversion, it the other way around, after you convert, you found that your cost is only 50 cents compared to the market, the mother's share price in the market is about more than 50 cents. Of course, the more higher is better for you. Then you can enjoy the difference by converting the warrant into the mother share. But do take note that this process might take you roughly 2 weeks time.
That was last time. Now, if you want to convert and all this, right? Some of the register actually just put it on like the Tracker website or any of the websites. So the transition is much more faster. You don't even need to send the file, send the form and all this as well now.
Yeah, anything right now we can do it online or through electronic way. Yeah, okay. Thanks for reminding.
So actually, pandemic did some good to us as well. Now, Brandon Su from YouTube also asked, so in front end case, right, it's not worth to convert the warrant to the mother share at the current exercise value. Is that correct? Okay. Now, Brandon, you asked a very fine question. So go back to front end, right? Right now, it's only started trading since June or July this year. If I'm not wrong. So they have a 5 years trading period. Moving forward, there's still 50 plus months to trade. Now, normally, back in as per our research, most of the warrants actually stays in the premium zone, so it's always shown to be expensive. Just if you were to compare to the current exercise value lah. But on a more personal note, normally I also don't convert lah. What I do is just trade in between. So I just call up Benny to ask if it's okay to sell now.
Yeah, and it save you from the sake of
Converting,
converting,
and bearing the risk for 2 weeks or 1 week to see if the prices actually goes up more further or not. But it's always in the premium zone.
maybe Jason, can we unshare the screen?
Unshare the screen.
Yep.
Sure. Okay, so Yep Singh has a question. Do you think there is really an arbitrage opportunity in the warrant? Buy the warrant and convert it? Because you may find the arbitrage, but the conversion takes some time, which you can't control. Yep Singh absolutely mentioned the right question. This is exactly what we mentioned just now. Yes.
Theoretically, yes, there is an opportunity for us to look into that, but bear in mind that taking the after factor in all this time and process, it could be the other way around, or at the end, maybe it's just nothing much you can enjoy it. Yep.
But if I were to put it this way, in my personal experience, it did happen before. It did happen before that we actually had the arbitrage opportunity. That's only because the warrants was very near to maturity date, and the prospect of the company is still very good. So I actually did buy some and convert and keep it for 2 months, and it actually goes up another 60%. So that was very happy ending. But don't do this for every warrant. It normally doesn't end it good way. Okay, only if the company, if the underlying share is going the right straight way up. Okay, if not, don't do that. It's actually a risk.
So which means to say that when we invest into a warrant, actually we are actually investing into the mother share. So it's very much depends on the performance or the future or performance of the mother share. So normally when we can observe that the price movement of the mother share and the warrant is in tandem normally.
Yeah. So the rule number 1 of investing in a warrant, right, is always one thing. The company, the underlying share company must have really good prospect. It's always a growing prospect. If not, even if it's cheap, right, not worth it. Not worth the risk. Okay, so Benny here has a question. Why my name mentioned? Because you show up in my heart. But literally, every time during investment, we actually do ask for a second opinion. Sometimes we ask ourselves, yet we also question ourselves. So we always look to see our gurus like Benny or Andrew, Alvin, all these people as well.
Sorry, for me to adjust the camera because it looks a bit blur from our end.
Just want to keep it. Okay, right. Okay, Yuan Tong was asking if warrant expired, so we lose everything to zero.
No.
If the warrant expired, basically just become waste paper lah. Last time is you still got the waste paper, you can sell the waste paper. Now it's all electronically hidden in Bursa, so it becomes an entity inside your portfolio lah.
Maybe what you can do is after expired, the last choice is that you proceed with the conversion within the time frame, and hope to again rely on the mother share's performance in the future. When the mother share can perform well, then you still can enjoy from the mother's share.
Yeah, but Yuan Tong was asking if the warrant already expired.
Oh, then
what? Nothing to do.
So very important for you to keep an eye on the expired date. Yeah. So write a very big note and stick to your anywhere you to remind you the expiry date. Yep.
Or it becomes like us right now. We have an example exactly that we actually lost that money.
That's why
Become a lesson to us.
Yes, for me personally, I do rather consider mother share or sometimes over warrant is that just to take out the in case I forgot to exercise or to convert. Yeah.
Okay, so CL here asking how to calculate or where can we find out the initial value of warrant? Okay, this is a very tough question. We don't exactly need to calculate, but we do able to see the initial value of warrant normally zero because it normally comes for free, comes in free. Discount voucher comes in free. So unless you're asking about what is the perceived value or perceived perceived value of the warrant, then that is a very interesting topic. Perhaps we can discuss further during class. That is a very long topic. From Gyapsing here was asking for warrants issued by the company, not called warrant.
Okay.
For warrants issued by the company, do the company able to apply to Bursa or SC so that the company can extend the warrant expiry date? That's a very good question. That's a very good question. If I remember correctly, I did not the CFA papers was very long time ago. I have not been reading it back. Okay, so if I remember correctly, it should be able to. You can apply to, but normally nobody does that. Normally nobody does that.
So actually, why one of the reason why some of the company issued some warrant is actually it's a tool for them to raise fund. So during expiration, so once you convert, that means you are putting some extra money to the company.
Yes. So earlier better.
So why the company intend to extend it? Yeah,
you can, but normally nobody does that. So imagine like you have the discount voucher to exchange for the cakes, right? You definitely hope that they come back within 1 month instead of extending it for them. They come within the year, right? So definitely you're hoping it to be shorter instead of longer. Nobody actually extend the expiry date.
So back to the perspective of the business, as a businessman, you always welcome the business coming in or the money coming in.
So for Gyapsing, thank you for your question. I'll ask this to my lecturer.
Theoretically, yes, but for time being, we never see it seldom happen. Yeah.
Yes. All right. If there's any more questions, do come ahead.
Yeah, please. We can. It's a very interesting topic. We can discuss it over here. Especially, we always being asked by, especially the beginners, what is warrant, how to invest. So when you wanted to invest into a warrant, just do consider all these factors: expiry date, what is the conversion, whether it's in premium or discount. Yep. And some when convert, do take note that it requires, say for example, 2 warrants in order to convert into one mother share, something like the different ratio. So you have to consider that as well.
Okay, so Gyapsing was asking this in the company. In the company would want to extend the warrant if the warrant is underwater. So like in the money, so nobody will convert it. Again, Gyapsing, it's always a perception of being premium or discount, or sometimes there are a lot of future prospect to be told about the company. It depends on if you believe it or not believe it lah. So it's all boils down to the fact that if you want to convert or not, it's very personal. To be honest, it's very personal if you want to convert or not. But actually, it's easier for them to just cut it off and give you another new discount voucher. So Gyapsing was asking as well, by extend the warrant conversion period, the company can hope that if it do well, the company share price would go up, and the warrant holder would then want to pay money to convert their warrant. I believe what my guru is always saying, the company should always focus their mind on building the business and making sure the business goes better, goes well. So if the company is constantly thinking about if the warrant is in the money or our money, right, then I might need to reconsider if this is the right company for me as well. All right. There seems to be no more other questions.
Yep. That means our explanation and sharing tonight is very clear. So in the future, of course, as an investor, you will definitely encounter or having a chance to buy or receive a free warrant. So by the time you receive it or you plan to invest it, so do consider all these factors. So if not, then you always have a choice to whether consider buying a mother share. Do take note that mother share, some mother share are always constantly paying dividend, but by owning or investing in warrant, you are not entitled for any dividend. Yes, you are not entitled for any dividend as well as the voting right. So we do always encounter some cases that when we attend AGM, some shareholder come approach to the register saying that wanted to attend the AGM, but lately after that they found out the shareholder actually holds the warrant, is not the mother share, so they are not allowed to attend the AGM. Yep, we do see that before. Yeah, bear in mind that. So actually, warrants is actually as a leverage tool for you to leverage up or to maximize your return. But do take note that do consider the allocation in your portfolio. Okay, as it carries a much more different investment risk if you just owning a warrant in your portfolio.
Okay, thank you, Rasmawi, for the comment. Good job, very clear. Thank you so much. Now, Gyapsing also was asking, do you think warrant is still a good way to use small knife to cut big trees? What do you think?
Yes, it is a small tool, a leverage tool. So we used to call it small knife to cut a big tree. Okay, with the limited, maybe say for example, in certain case with the limited amount you have, then you may consider when you analyze a mother share, you found that there is a tendency or potentially this share will perform well in the future because of the trend or the product that they have in the market is very trendy or very booming product, then yes, you may also consider if that is a warrant. So with the limited normally because of the leverage of the gearing, say when the mother share is at 10 ringgit, the warrant is at 1 ringgit. Say for example, if they have a gearing ratio of 10, so when we say we have a limited investment, say for example with and less as a few as
1% of a portfolio or 5% of portfolio.
Yes, you also can consider that. Yes, definitely.
So in a short answer, yes, definitely warrant is a very good way to use small knife to cut big trees. Definitely, there was no doubt about it. But there is also risk involved. So we definitely want to keep a certain portion of the risk only within our portfolio. Not too much that we can't sleep at night, but not too little that we don't get to involve in the fund, right? So definitely it's a good way to use to as a small knife to cut big trees. Now, or the second question goes with, or you would rather buy shares to be more secure. Now, the question goes back to very simple. If the company is growing, and only if the company is growing, then why not get some warrants to get some better returns? If you're not sure about the underlying companies, then why expose yourself to the risk? So it all boils down to how sure are you of your investment? How firm are you in allocating your capital? All that we can learn through our classes.
Yes, bear in mind that the warrant also acts as a double sword
Double-edged
knife.
sword.
Yes, the other way around, when the market is fallen, then the market share is fallen. Warrants is much more, dropping much more compared to the mother as well. So this is the other way around. So do consider the reward and the risk as well. Yep. So let's check. Is there any questions? We left out any questions?
Okay. Chris also mentioned a very good point for us. Now, when the warrant exercise prices, right? It's stated there is for the 5-year tradable periods, but the reason we actually noticed that when there is company bonus issue or capital changes, right? Then the warrant prices actually exercise price will actually be adjusted. Now, another benefit of warrant is that they are not entitled for rights issue, but exercise price will also be adjusted. Also, shareholders don't need to fork out more money if the company asks for rights issue. This is one of the perks of having warrants.
So which means some certain company, they have the warrant. They have the warrant, then they have a right issue at the same time. So what happened to the current or existing warrant? So this is normal. The question that always asked by the shareholder. Yeah, what happened to the warrant? They know about the mother share will change accordingly, but what happened to the warrants? So the exercise price, basically the exercise price will be adjusted. Yep.
So Gyap Singh here asking, can you share some of your success and failed stories? You want to take the success or you want to take the fail one?
Yeah, you go first. Yeah.
Okay, actually, a few of my success stories with warrants, right? All three of them also technology companies. So one of it being the Unisem warrant. That was back in 2018 or earlier, if not wrong. They were actually 2 months near to the maturity date. It's actually against our personal protocol that we don't buy anything that's going to be matured in 3 months already. But that time, very, very sure, I see the Unisem prices, they are going to have a new investment coming in. And that we know that this potentially brings up a lot of revenue to the company. So I actually bought in some. And within 2 weeks, I actually gotten 40%. Very happy, go out. Then after that, it goes up another 20%.
So you earn
Eventually,
less.
I earned a lot. Earned quite some money for the Chinese New Year, but then I could have earned more. I could have earned more.
So, okay, so while Jason talking about his success story, I share with all of you some painful story where I have to roll back. I think about 10, somewhere near to 10 years ago. I still remember I own warrants of this company, which is already delisted from Bursa Malaysia, Hobbit. So Hobbit did have some warrant at that point of time, but until the expiration, I do not have a chance to convert it, and because this warrant plus the exercise, actually we can back to the formula again. Mother share equals to the warrant price plus the exercise price. The exercise price itself is much more higher. The price is much more higher than the mother share. So what can I do? So nothing much I can do. So, but luckily I just own a small portion. I mean, in terms of percentage in my portfolio, it's just very, very little. Yeah.
So that one koya already become waste paper.
Yes.
Literally. Yeah, that happens. So we do have some success stories and we do have failed stories. This happens. That's where we learn. We pick up when we fall down.
So all good. Yeah, looks like we already answered all of your questions. So thank you again for your questions, and thank you again for joining us for the webinar tonight. We do hope that you learn something, and we are very happy to share together with you. So thank you again thank you to Afin Huang Investment Bank to bring us this webinar tonight. So remember, for those interested to download the slide tonight, please refer to the link given.
So just go to bit.ly/15 DEC slides. Thank you once again for tonight. Hope you learned a thing or two, and have a good night's sleep.
Thank you.
See you in the next one.